exchange traded funds. So
ETF.
last week, oh yeah, good old ETF. So if I say ETF, I mean exchange traded fund, because I'm not going to keep saying that because I'm going to start stumbling over my words and you won't trust the rest of the things I say. So last week we talked about mutual funds, and I talked particularly about how they can be affected by management costs and the incentives of the managers, and therefore why I don't like them. And then Chris and I had what we could call a vigorous debate about the fact that he does like them. We're going to talk today a bit more about their more modern equivalents, the ETF or exchange traded fund. So mutual funds first came about in 1924, and these came about in 1993. So much, much more modern. So let's first look at how they're structured. And to do that, we're going to pretend that you want to buy a bunch of companies in the stock exchange. You want to buy some Amazon, you want to buy some Google, some Tesla, Netflix, and Facebook. You're really bullish on growth technology stocks. Now, you could go out and just buy individual shares in the companies, and maybe you've got enough money to do that. Maybe you could buy a few of them. But maybe you're more like us and you want a different way of going about it, something easier, something cheaper, something that you're going to have to manage less yourself. Well, you could find someone else who's already got shares in those companies and just buy a little bit of theirs. So let's say Cathie Woods, who is a famous fund manager herself, has gone around and collected all of those shares in those companies in her shopping basket. Well, ideally, you just want to buy a piece of that shopping basket, and then as those shares grow, your little piece will proportionally grow. That is the basic idea of an ETF. So let's look at how they would be priced, for example. So let's say that she's bought one each of those shares in those companies. Amazon last week was about 3,300, Facebook 320, and so on and so forth. If she went out and bought exactly one share in each of the companies, they would total up to about $7,070. If she broke down her ETF into 100 shares, you could go and buy one piece of the ETF or the shopping basket for $70.70. You would then own 1% of one share of Amazon and Facebook and Tesla and Netflix and Google for much, much cheaper than you could own any of them individually. And you would then have to do no further management. Cathie would make sure that her fund tracked them, bought when necessary, sold when necessary, and you could just collect the dividends and the capital growth as normal. So that is all very similar to how a mutual fund would work. The main difference between the two comes between passive and active management. So mutual funds are what's known as actively managed, and that's where the people running the fund buy and sell out of positions to try and beat the market. Now, beating the market means different things for all of them, but that's essentially what they're trying to do. ETFs, typically and until recently legally, are passively managed, which means they don't try to beat the market. In fact, they try to exactly match whatever thing they're following. And we're going to come to that in a minute. But that means they don't buy or sell based on particular strategies or signals or anything. They just buy and sell in proportion to how the market moves. It's the difference between individual stock picking and just following an index. So I've said index quite a few times, but what exactly does that mean? Well, an index is any predetermined selection of stocks. That's it. It's as simple as that. The most famous one is the S&P 500, which is the 500 biggest companies in America. And in fact, the first ETF that was introduced in 1993 was the one that follows the S&P 500. That accounts for about 70 to 80% of the US market. The biggest ones at the moment in the S&P 500 are Facebook, Apple, Amazon, Netflix, Google, all those tech companies. Warren Buffett's Berkshire Hathaway is up there as well. Now, another one you could buy would be, say, Vanguard Information Technology ETF, and that would be something that follows high-growth, disruptive technologies, things that are trying to change the way we live. That's a different type of ETF, but it's the same structure. Or if you're really boring and you're like a 100-year-old woman, you could buy the iShares MSI USA Minimum Volatility Factor ETF, which is an ETF that just tries to not move. It's made up of a whole bunch of companies that don't go up if the market goes up and don't go down if it crashes. It just stays stable. Personally, I think that's the most boring thing alive, but maybe it's the right thing for you. And the whole point of this is not to say one of these is the right one. It's to just say that no matter what you're interested in investing in, there is an ETF that follows it. There's something like 3,400 of them in the world. So whether you want to invest in the US market, high growth technology stocks, stable stocks, African markets, emerging markets, whatever you want to invest in, there's an ETF for you. if you say wanted to invest in green energy, like Chelsea's interested in, like Seb's interested in, a hydrogen ETF maybe is the way to go for you. Now, at the moment, this is just a side note, the S&P 500 is the most famous of all of these ETFs, and it is heavily, heavily, heavily weighted towards these growth tech stocks, and they are, in our opinion, overpriced, which means that the whole ETF could come slamming down if they get adjusted for price. So that's something to be wary of. So what are some of the advantages of these ETFs? Well, the first one everyone will talk about is diversity and exposure. So let's address each of those. Diversity is a key term that is always talked about when investing, and is this idea of not sitting with all your eggs in one basket. So if you invest in the S&P 500, you've got a little bit of money in 500 different companies, which means if one of them crashes and burns and goes bankrupt, you don't lose all your money, just a little bit of it. And it will be more than made up for by all the other companies that do well. The flip side of that, of course, is you've still got some money in the companies that do poorly and less money in the companies that do well. So you don't capture the same gains as if you just invested in the great companies. But that's hard to do, which leads us on to exposure. 25 years ago or 30 years ago, if you could have invested in Apple or Microsoft, you would have made so much money. But would you have invested them 25 or 30 years ago? Probably not. You know, it's easy with hindsight to say, yeah, they're fantastic and they changed the way we live. But 30 years ago, maybe not. Had you invested in an index fund, however, they would have bought a small portion of those companies and you would have captured some of their massive gains. And that is that idea of exposure to all the best companies. You don't get the huge wins, but you do get a little bit of all the big wins. How does it relate to us as lead pass investors? Well, it comes down to how confident you are in your investment strategy. Now, we aim to return 15% per year with our investments, which doesn't sound like a lot, but it does mean we double our money every 5 years. The S&P 500 index or the FTSE 100 index both return about 10% per year before inflation. And that is basically zero risk. Over the long term, it will definitely do that. What that means is we have to be really, really confident that our strategy is going to do better than that. Otherwise, we are much better off just investing in an index fund. And in fact, Warren Buffett is famous for having said that, and in fact, repeatedly saying that most individual investors should put 90% of their money in an index fund or an index ETF and use the last 10% to pick stocks individually. We're of the opinion at LeadPass that you can do better than that if you know what you're doing. If you research the companies you're investing in, do the requisite research on the management, the market, and all of that, and make an informed decision. Because many individual investors that Buffett is talking about just don't do all of that, and they just buy the random hype stocks that they hear about and then lose their money. Now, why are they for us better than mutual funds, or in my opinion at least? It comes back to this graph. This is what happens to your returns in a mutual fund based on the 2% cost that the management take. You can see that it drastically reduces your returns. I said earlier in the presentation that an ETF has a much, much lower cost than a mutual fund. And in fact, compared to the 2%, it's 0.1% roughly. And that means the returns look more like this when compared with the market. You capture almost all of the gains, and the small difference is well worth not having to buy a little bit of every single company. It means you don't have to manage anything. You can buy with small amounts, invest regularly, and see your growth grow over time. So that sounds great, but I'm not investing them at the moment. Why is that? It's because I think the whole market's overvalued. Now, that doesn't mean that they're not good investments for the long term. It just means for the short term, I don't think I should be buying something that I think is too expensive. And so I'm waiting until the market comes down and therefore these ETFs come down, at which point I'll probably start putting a small percentage of my investment portfolio into these ETFs for my long-term retirement, that if everything else goes wrong, at the very least, there's that to back me up. I want to finish by talking about a woman and then a man called Cassandra. So for those of you who don't know, I'm a big nerd. And if you don't know that, then you clearly haven't been listening to me talk. But I love Greek mythology. And there's a figure in Greek mythology known as Cassandra, who was cursed by the gods to always tell true prophecies, but no one would ever listen to her. It also happens to be the Twitter handle for Michael Burry, or it was before he closed his Twitter down. And that's because Michael Burry feels that he constantly predicts things and warns people about catastrophes in the market and doesn't get listened to. So he's the man who predicted the 2008 financial housing crash, predicted it, no one listened to him. No one believed him. He has said about index funds that although he likes them, he feels that they are fueling a bubble in the market because more and more people are putting their money into these index funds, which then have to go and buy up shares in the indexes that they follow, therefore driving up the prices in those index, causing more people to invest in the funds, causing the prices to have to go up, and so on and so forth. And he says that once that tide changes and money starts to come back out of the funds, there's going to be a huge rush of money out of the market, and that might well be what causes the bubble to pop, or one of the things that causes the bubble to pop. So what do you all think about that? Do people here invest in index funds already? Would you invest in the index funds having heard about them now? Let me know what you think.
Hi there. Thank you so much for watching our video. I hope you really enjoyed it and I hope you learned something. If you have any questions, please let us know in the comment box. And don't forget to like and subscribe so you can learn more about our channel. Thank you very much and see you next time.